So, good afternoon, everyone. I'm Rajkumar Subramanian, and I'm delighted to be your host for the webinar today. On behalf of PL Wealth, I'd like to extend a very warm welcome to all of you. Thank you for taking time to join us, and we hope we have an engaging session. And I'm quite excited to get started. Let me introduce our guest today. We are delighted to welcome Mr. Devang Shah, Head of Fixed Income at Axis Mutual Fund, one of India's leading asset management companies. Devang brings with him over 2 decades of rich experience in fixed income investing, portfolio management, and interest rate strategies. At Axis Mutual Fund, he leads the fixed income desk and is responsible for driving the strategy across a range of debt products from ultra short-term duration to long-term gilt and dynamic bond funds. Devang is widely respected in the industry for his sharp macro views, deep understanding of interest rate dynamics, and a pragmatic approach to managing duration and credit risk. Devang, welcome to the webinar.
Thank you.
Very keen to hear your views on the fixed income and over to you on that note.
Yeah. So a very good evening to everyone, and thanks Raj for all the kind words and the kind introduction. Obviously, I first thing which I spoke to Raj is that fixed income and a topic which has been discussed is very dear to me. I've been managing now fixed income funds for 20 years plus, and in this industry for more than 22 years. So I just wanted to check across. Yes, in markets today, large part when equity is so has given such phenomenal returns over the last few years, and fixed income after the tax efficiency going, investors have actually lost some interest. It is last 1 year where I think again fixed income has regained some space, and there are some interesting things which is happening both on macro and on the regulatory side, which I will probably like to cover and in this next 30 to 45 minutes, and try to probably get your interest back on fixed income. I think first of all, it's good to hear that over the last 12 months, if I look across at fixed income returns and compare it with large cap, mid cap, small cap returns, actually fixed income funds have outperformed all. And that is why what I think Rajkumar was focusing on when we had a small discussion just before this call is that asset allocation becomes a lot more important in these uncertain times. I'm sure whenever you have spoken to market participants today, and we have had multiple webinars till now, the general concern over the last 1 or 2 quarters has been all about uncertainty. And it was uncertainty about what's happening on the external side, tariff tantrum, geopolitical risks, somewhere down the line, earnings, growth, and actions of central bankers. There were so many uncertainties and which actually led to a lot of volatility in our markets. In all this time frame, I think one thing which was very important was that in the bond side in India, yields continued to rally, and that was because of significant changes in macro dynamics over last two years. First, I'll try and cover what happened in the next 5 minutes, what happened in the last 12 months to just take you guys on the same page where we are today, and then explain what's the view going ahead for the next 12 to 18 months. And lastly, I'll again probably touch base on what products investors should invest into in this category at this point of time, depending on the macro dynamics. To start it, I think exactly at the same point of time last year, we just come out of the elections, the election embargo, government had significantly stopped spending. So June 2024, April to June 2024, government spending was significantly less, and which has been a big delta for growth in the last few years. Government capex, fiscal expansion, fiscal impetus has been one of the biggest drivers of growth in the last few years. But in the last year, at the same point of time, Q1, April to June 2024, we saw that tap to be closed, and that was more because of the election embargo that people don't spend. At the same point of time, RBI became very vigilant, and RBI started questioning that what's happening on markets, personal loans, microfinance loans, unsecured loans, and it started getting worried that somewhere down the line there can be a big impact on markets and NPA cycle can worsen. So RBI significantly tightened the credit norms. They increased risk weights on personal loans, microfinance loans, significantly directed banks to lower the credit deposit ratio. If you don't have deposits, don't lend. And that created significantly tightness in the financial conditions. Credit growth slowing down is the first indication of any economy to slow down, because credit is the way where it is the circulation of money and velocity of the money which creates growth in the economy. And somewhere down the line, I think RBI's thought process that somewhere economy is overheating and specifically certain segments and pockets were overheating probably led to financial conditions getting tighter. At the same point of time, September onwards last year, again we had this entire US exceptionalism theme, where which led to a lot of flows from emerging markets to America. Everyone thought that Trump will make America great again, and let's probably invest only in America for the time being because tariffs will be get implemented. You will have tax cuts. It's only America which will make a lot of wealth and value for investors. Hence, what happened is the emerging market country like India saw big outflows. Again, impact was drain on the liquidity because you saw a lot of FX outflows, you saw fall in reserves, banking liquidity got very tight. So if I look at April to December last year, I think there were three big drivers and which all led to slowdown in India. One, government spending significantly slowed. Secondly, credit conditions massively got tightened because of RBI's own cautious approach. And third, banking liquidity got worsened because of significant drain of FX outflows. Resultant, obviously, we saw Q2, Q3, Q4 GDP to be significantly well below government and RBI estimates. Now, then comes the action. I think they were quick enough to understand that economy needs at this point of time a complete support from policymakers. And both of them come all together to support the economy. I think government did whatever they could because they were somewhere down the line very keen on fiscal consolidation. At this point of time, government focus is that I should lower fiscal deficit so that the credit growth in India starts. I should somewhere down the line lead to lower interest costs and spend that money into efficient allocation towards capex. So the government was working with fiscal consolidation, but in that fiscal consolidation also they had some room and they actually took out some allocation from capex to spend to the common man, to the middle income class, and gave some tax relief. So without doing anything on fiscal, they changed certain parameters to ensure that growth gets the immediate support and we see some kind of buoyancy back into the economy. But heavy lifting had to be done by RBI. And RBI has done a superb job in the last 6 months. I think post the change in the governorship, RBI has gone all out to support Indian economy on all fronts. First of all, they reversed all the credit tightness which they did last year. Large part of it has got reversed. NBFC risk weights have been reduced. The gold loan and infra loans, which they were probably going to come up with tighter guidelines, they have relaxed. LCR guidelines got relaxed for a year. Somewhere down the line, risk weights on microfinance got reduced, except for personal loan. Everything was rolled back. Secondly, they pumped liquidity into the system to the tune of 10 lakh crores. So we had tightness from RBI because of uncertainty last year. FX outflows led to significant deficit banking liquidity. Banking liquidity went to a deficit of 3 trillion in December 2024. From there, we have moved to 6 trillion positive. So all thanks to RBI. RBI did a 10 lakh crore of liquidity infusion and still going to do more September onwards. I think the second step which RBI did was massive liquidity infusion using various tools. They use OMOs, VRRs, CRR cut, everything. Last piece to support the economy has been this massive rate cut cycle. 100 basis, I think front loading of the entire rate cuts to ensure that economy gets supported. Three questions which comes out from this monetary policy specifically is that why RBI cut 50 basis? Secondly, why in such kind of, and if I am seeing there's so much of liquidity to the system, why then somewhere down the line liquidity is it being infused more in September? Why there's a CRR cut? And third thing, if RBI is so dovish, then why change the stance? These are the three emerging questions which I thought I'll address first and then probably take the macro scenario going ahead. My perspective is that one, they've done a lot and probably they thought that this is a time where significant control is there on inflation outlook. Whatever stress we give to inflation, inflation for the next 6 months continues to remain below 4%. If that is the comfort which RBI has, RBI said, let's probably paddle more towards the growth, support the growth at this point of time. And that is why front loaded the rate cut. Rather than doing 25 in two tranches, they said, let's go all out and do a 50 basis in the last policy. Second, I think liquidity. So they called up all bankers. I think this is my thought process. They would have called all bankers and said that, okay, I'm doing a front loading of rate cuts. I want transmission of rates throughout. How do we go about this? Because unless and until transmission of rate happens, the economy will not start borrowing again. And somewhere down the line, the support or insulation which we want for growth won't happen. So, how do we get the rates lower for the end borrowers? The general response would be that we need more liquidity and the liquidity should remain in the system for a long point of time. And that is why RBI said that, okay, let me do a front loading of a CRR cut also, announce it to give confidence to the bankers that go all out and reduce rates. So that is why I call this policy a very iconic policy, because he has not only given a forward guidance on what monetary policy can do and cannot do, but has also done a front loading of rate cuts, front loading of liquidity measures, and given a clear message that rates should remain lower for longer and we are here to support the growth and the economy. So our perspective is they would have done some calculations. The rough calculations came out to be a 1 to 2 lakh crore of liquidity requirements in the second half of the year. RBI said, let me do even that, and hence the 100 basis of CRR cut in advance starting from September. The stance change, I think, is more from a communication perspective of forward guidance, communicating to markets that yes, firm monetary policy, any which ways has its limitations, because I have to look at real rates, I have to look at inflation, I have to look at external situation. So whatever was required to support the growth, we have front loaded. And now onwards, actually actual space available is very, very limited, and hence we have communicated a stance change. So I think it's a very, very well thought monetary policy, and hence we saw multiple actions from RBI. A rate cut, front loaded of rate cut, front loading of CRR cuts, and the communication of a stance change. Now, going ahead, what do we see and how do we see the macro panning out for India, global markets, and what should be the impact on bond yields? I think the message is very clear that rate cuts from here on will be very, very limited. And unless and until we get a growth or an inflation shock, which is significantly lower, we don't anticipate big bang rate cuts. Can it do a 25 basis more? Answer is yes. But will there be big bang rate cuts from here on? My view is no. And our assessment is that growth, if I look at the growth drivers in India, they've already done a lot. And somewhere down the line, September onwards, growth should start looking better. And so after the festive season, we believe H2 growth should pick up. We're already seeing some kind of green shoots on the rural economy. Urban consumption still continues to remain weak. That is where the concern is. I think if urban consumption picks up because of the interest rate being lower, festive season onwards, we should start seeing some kind of revival in growth. Will India growth be back to 7.5? My personal view is no, because we are in a fiscal consolidation mode. We are still at the external instability, because US and specifically the Republican President Trump keeps on communicating on either side, and the tariff uncertainty, tariff tantrum will kind of delay capex, delay employment, and somewhere down the line delay spending. So on all perspectives, I think external situation still continues to remain weak, but inflation well under control. I think the RBI would continue to keep rates lower at this point of time for a medium term. So for us, rates continue to remain lower for longer. Though rate cuts are limited, we don't anticipate any kind of rate hikes because inflation is well under control. Commodity cycle looks comfortable. Today, markets are more worried about dollar than rupee, and hence our perspective is that RBI can stay on a pause for a longer point of time. RBI has been very supportive on liquidity, and we believe that RBI will continue to keep liquidity supportive, positive, and continue to ensure that NDTL liquidity continues to remain above 1% of NDTL. With that context, I think short end of the curve will continue to behave very, very well. Long bonds will remain here, will trade in a range. Now, coming specific to the external situation, because that is something which is a worry. And last 3 months, in fact, starting April, everyone only asking us what's going to happen on tariffs and the implication of all of those on Indian economy, macro, global, China, everything. So if I summarize, I think first and foremost thing is that US economy and Trump himself has realized that the biggest loss of tariffs is to US economy. And hence he has rolled back large part of it. Even after rolling back large part of it, tariff still stands at 15% plus, 14-15%. So with that context, will there be a slowdown? Answer is yes. You cannot avoid a slowdown in growth everywhere. So previously, I think on the Liberation Day, people spoke about that US economy will probably go into recession from a 2% growth last year. China growth will half from 4.5 to 2. Europe will probably go to 0% growth, and India will probably collapse from 6.5 to sub around 5.5. Today we see that US will continue to grow at 1.5% on GDP next year. We believe China will still continue to grow at 4%. We believe India growth will be upwards of 6%. And lastly, because of the fiscal push in Germany specifically, Europe growth will also be above 1%. So that's the context where we are today. That yes, growth is weaker than what it was last year, but growth is not going to take a big setback. Second, I think the concerns were significantly higher inflation in the US and disinflation everywhere. We believe neither there will be a huge disinflationary theme or there will not be a huge inflation shock in US also. Our perspective is US markets and somewhere down the line started and US economy started to slow down. Let's look at the macro data on a holistic purpose, which is employment, growth, inflation, and the retail consumer behavior. Inflation has not inched up despite tariff being announced. It is still hovering at 2.5 to 3%. If you start looking at the real time data, the high frequency indicators, consumer demand has collapsed. Employment is on the verge of rising. So, our belief is that what the worry which global markets had that US inflation will go above 4% and people will start seeing Fed to hike again and US treasuries will blow up and that will have an impact on entire globe. I think that is slightly overdone, and we believe that Fed will continue, in fact, with its rate cut cycle. Our assessment is you would see two rate cuts in this year. Is there a possibility of three? Yes, but my personal view, is a two rate cut in this calendar year. From July to December, we anticipate two rate cuts from Fed, and we believe that large part of the pain on US Treasury is behind us. Now, the concern comes across is that what all this then derives for in India? What in an environment where local growth is continued to remain weak, not significantly strong. India growth will hover between 6.5. India inflation at sub 4. External situation comfortable. Commodities, specifically crude, because of weak demand, I think continues to hover between $60 to $70. That's only because of the geopolitical uncertainty. We believe crude is at 70. Otherwise, crude should be between $50 to $60. And in an environment where you are slowing everywhere, I think monetary policy will still continue to drive everywhere. And we will see rate cuts. Rate cuts will be limited because a large part of the global central bankers and India has front loaded large part of the rate cuts last year and some part in the first half of this year, but rate cuts would continue. Secondly, if slowdown is there, I think monetary policy will continue to act and somewhere down the line, the rates will remain lower everywhere. Secondly, if slowdown is there, we don't anticipate an inflation shock anywhere. So that's the global backdrop for us, that you have a slowing economy, a significantly lower inflation perspective as compared to what all of us believed when tariffs got implemented. And the third aspect is that because of all this, India growth outlook will be a tad weaker and somewhere down in a lower inflation regime. Though RBI will not be significantly cutting rates, RBI will also not be hiking rates. Plus, to ensure monetary policy transmission, they will continue to keep banking liquidity positive. I'll give you some facts now more to convince you about what kind of liquidity RBI is induced and what it can lead to for markets. In the last 6 months, RBI has actually induced more than 10 lakh crores of liquidity. Now, Today, banking liquidity, banking and government put together is 6 trillion of liquidity, 6 lakh crores of liquidity. Where have we seen such kind of liquidity in the last 17, 18 years? I would say all the three instances before this were accidents or emergency situations. It was global financial crisis in 2007-8, it was COVID in 2020, and 2016-17, which was demonetization. Except for these three scenarios, such kind of liquidity in the banking system we have never witnessed in the last 17 years. So the point I'm trying to put across is that RBI has done a very good job of ensuring that liquidity continues to remain supportive and banks should now transmit rates. If I give you some color, large private sector banks deposit rates have collapsed by 135 basis on their deposits. They were at 775. I'm talking about India's top large private sector and PSU banks. They were upwards of 775 in February. Today they are below 630. So I'm just trying to put across that RBI has ensured that rates come down massively. Lending rates will come down with a lag because of deposits mobilization, which is slower. MCLR linked loans gets repriced slower. But our perspective is by H2, large part of the lending rate should come lower. Now, coming to the context that, okay, Devang, if you're saying liquidity is so positive, what should investors do specifically for fixed income markets? I think we have been writing since March that last year was the theme for duration, just own gilt funds, and that will make a lot of value for you. I think in April we came out with a piece on that liquidity is significantly going to remain surplus, and now is the time that this year would be the play on the liquidity segment. So the short end of the curve, as per us, makes a lot of sense for investors. Just buy the 2 to 5 year corporate bond segment, and that, as per us, is the most beneficial out in such kind of macro environment where you have ample liquidity, limited rate cuts, and because of that ample liquidity in the short term, there's this liquidity circulating within the banking system. There's a lot of chase for these short-term assets. So we believe the short end of the curve makes a lot of sense for investors. This year is the theme for liquidity and accrual. Next year, it will be the theme for pure accrual as per us. So that's the view which we have. 2024 was a year for duration. 25 beginning April, the year for liquidity. And since the second half of the year, I would say probably October to December onwards, the theme would be then carry and accrual. So that's the way we position and advise our clients over the next 12-18 months. In that context now, what funds should investors look at and what should investors do? We believe that post tax efficiency going, investors didn't want to invest in debt funds. And in fact, a large part of it moved to arbitrage, equity savings, or performing credit, depending on their risk appetite. That is how we saw the investor basket and specifically retail investors. Because I think in India, people believe that we should have a tax optimal solution. People don't like to pay taxes. Okay, so the thought process is that, okay, from a market perspective, I can somewhere down the line find a tax optimal solution. Let's go and find that. So there's a lot of, I would say, a shift of money from debt funds. Post the 2024 tax bill, there is some clarity whereby some clarity has emerged on a category where which is called a debt plus arbitrage fund of fund category, where if you hold your investments for 2 years, you will be taxed at a 12.5%. So this category, as per us, comes out to be a clear solution going ahead for all debt investments. And we believe that this is a perfect debt solution for all investors, which will beat all your traditional solutions, which will give you better than corporate FD kind of returns. And somewhere down the line, it will also help you to capture the interest rate cycle, the liquidity cycle, the accrual cycle. So as per us, the debt plus arbitrage FOF category comes out to be a clear solution for investors going ahead. What this category is largely, it's a fund of fund where 65% of the funds will be invested in traditional debt funds 35% will be invested in non-debt category, which is arbitrage. The combination of the two, once if you hold for 2 years horizon, I'll repeat, the tax benefit kicks in only and only if you hold this product for 2 years. Then the optimal tax rate would be 12 and a half in the hands of the investor. So it gives you a debt-like return because debt plus arbitrage is nothing but fixed income. Even arbitrage funds gives you over a medium term like fixed income returns. So it gives you a debt-like return and probably an equity-like taxation. In other ways, it takes you back to pre-2023 taxation regime for mutual funds. So we believe that this category would be the best. In fact, in our fund also, what we have done right now, we are going to run a debt plus arbitrage fund dynamically. And today we are running into the short end of the curve, which we anticipate to make value for investors in the debt segment. So our perspective is going ahead from a solutioning perspective, debt plus our a fund of fund category comes out to be a clear solution for investors. If I summarize our thoughts and probably for the interest who have for interest of people who have joined in a bit late, what is our view? What advice are we giving to our clients in this macro environment? I think first, markets will continue to remain uncertain. People will still have uncertainty about tariffs. People will still have uncertainty about earnings. People will still have uncertainty about policy actions and what happens to the US economy. Our view is that in this uncertainty environment, today, debt comes out to be a clear solution for clients, for investors in a macro environment where inflation continues to remain low, growth continues to muddle around, and external situation remains comfortable. With that context, we don't anticipate huge rate cuts, but we believe that rates are going to remain lower for longer and liquidity is going to remain amply positive, as I explained. 6 lakh crores of liquidity plus CRR cuts kicking in from September will keep liquidity positive till March 2026. With that context, what we advise clients that with the changes in the tax bill last year, the debt plus arbitrage fund of fund category, whereby if you hold your investments for 2 years, you get a tax rate of 12.5%. And this category comes out to be a clear solution for investors going ahead. We believe that growth will remain weak globally and in India, and hence monetary policy support will continue, though it will be limited going ahead. The only word of caution which I will probably say is that return expectation from fixed income going ahead should be muted. But in an uncertain environment where all asset classes have performed so well over the last 4-5 years, I think debt still comes out to be a clear solution to preserve wealth for the next 12 months. So that's our thought process on bond markets. Happy to take questions. I think I just try to summarize for the investors.
Thanks, Devang. You've hardly left any scope to ask questions because you've literally covered all of these points. But let me still attempt a few questions, and I think there is a couple of questions on the chat boxes also. So now that India is getting gradually included in the global bond indices, JP Morgan, Bloomberg, FTSE, etc. How are you managing exposures across these inflows? I mean, do you see any curve segments or investments that are still mispriced or underowned?
Yeah. So see, first of all, Rajkumar, we all know that JP Morgan got included last year and large part of the flows ended by March 2025. So we got all that 24 billion money, and actually we were a big beneficial of that because that supported FX reserves, that supported GSEC demand, that supported yields. So despite large part of volatility in global yields, I think the general context which people have is if US yields are rising, India yields also rise. But I'll in fact give you a context that if you look at the last 3 years, May 2022, I remember the date specifically because RBI came up with a surprise rate hike. 2nd May 2022. From a perspective on Fed policy, RBI did a policy hike one day before Fed. So RBI hike rates 50 basis and Fed then hiked. From May 2022 till now, if you look across at US Treasuries are up by 200 basis. They were at 160 then, today they are at 425. So, sorry, 200 plus basis. And if I look at Indian 10-year, we were at 760 then, and today we are at 630. So this entire we have actually seen a reverse direction that Indian yields have rallied and US treasuries have gone up. This never happens, right? In the last 30 years, all of us knows US treasury goes up, Indian treasury goes up. So the point I'm trying to put across is that first, our bond markets have significantly decorrelated with what's happening on global markets. Two reasons for that. We are significantly less on ownership on FPI. In equities, we have a decent 14% ownership, but in bond markets, we have less than 3%, less than 4% ownership. So that's one reason. Second, I think JP Morgan flows have all been absorbed. Incrementally, we don't anticipate big flows. My view that long bonds will not probably perform can go wrong if we get added in Bloomberg indices. So Bloomberg is also up for review every year. Every September they come up for review. If they believe that they would want to add us, then we get another 25 billion of flows that can take yields to below 6%. But except for that, I believe long bonds will continue to trade where they are. Short bonds will continue to probably keep on rallying with every liquidity announcement, and specifically till September, till the CRR cuts gets announced. We don't see any anomalies in the market today. In fact, the curve has significantly steepened now. And I'll give you the context. In India, 18 years or 20 years curve remains largely flat. Why so? RBI always believed in keeping liquidity tight. This is and I gave you that context. 17 years, three times that RBI has kept such loose liquidity. In such loose liquidity, the curve steepens. What does the curve steepening means in simple terms? Short end is at a lower level and long bonds at a higher level. So you have a 1 year at 5.5, 1 year treasury bill, and a 10-year GSEC at 6 quarter, and a 30-year GSEC at 7%. So you have the curve to be steepening. Why so? Because long bonds always trade on account of future rate cuts. Now future rate cuts are not happening. So long bonds now look at two main macro dynamics, which is rate cuts and secondly the demand supply. We believe so that fiscal also consolidation is largely done. We don't anticipate any bit of fiscal consolidation going ahead. And in that context, I think the curve will continue to remain steepened because there are very limited rate cuts. So I think there are some questions about what was the popular bond market trade could unwind sharply. I think large part of that unwind has also happened. If I'm not mistaken, Pinky asked that question. So Pinky, the general consensus trade was just buy long bonds. We actually came up with a communication in April, May this year that large part of the trade on long bonds is over and we would see unwinding of those long bond trades. The curve is actually steepened. So 30-year, to give you some context, 30-year, 40-year GSEC and 10-year GSEC in February this year was at a 25 basis spread. Today, the spread is 75 basis. So that unwind is largely done. We believe so. The second unwind which can happen is if RBI withdraws this liquidity, then the curve will start, the steepening of the curve the curve will again get flat. But at this point of time, I will assign a less than 5% probability for the next 12 months because RBI has gone all out to ensure that liquidity continues to remain positive. And there's a reason why RBI wants to do that because RBI wants transmission of rates from bankers. So I don't expect any kind of unwind of immediate trades. One unwind was this long bond, which I think largely is done. Second, I think, sorry, Rajkumar, before you have any questions.
Yeah, I have a few more, but in case if you have any thoughts, I'll
No,
allow
I
you.
was trying to answer the webinar one. So first you ask the question, then I'll answer the.
Oh, sure. So, you mentioned Bloomberg as probably the next potential trigger if India gets included in the Bloomberg indices. Other than that, what do you see as probably the next trigger for the bond market? Could it be any other global development? Could it be inflation trend or probably any stance change from RBI going forward?
See, my understanding is when I'll give both sides the risks. because our view is, which is 80%, we believe that the curve will rates will remain lower for longer, and curve at this point of time liquidity trade will do better. Now, when bonds can rally further and vice versa, and bond yields can go up, let's look at both the scenarios. I believe that first of all, one reason is Bloomberg. If Bloomberg adds us, then yields can rally. Second is, we are all still believing that US economy doesn't collapse. And I personally believe so US will not collapse because they are still pump priming the economy with 6.5% fiscal deficit. Though a large part of it going towards interest servicing, but they're still ensuring some bit of growth. So I don't think, and with the tech innovations and everything, I don't see a collapse immediately. But if US economy collapses, then I think RBI will also understand that 6.5 growth will also not come, because if the largest consumer is not going to consume, if global growth is going to collapse, India on its isolation cannot grow at 7%. And RBI's new mandate is 7% growth. So they believe potential growth is 7%. Below 7, I should be accommodative. If that is the context, and if US collapses, can we see more easing? Yes. So I would say two reasons for rally. One, Bloomberg, and one, if US economy collapses. The other way around, what can be the risk for yields to go higher from here? I think one, the context is that all of us are still anticipating that growth to be weaker and inflation to continue to remain lower. If a geopolitical risk resurfaces and we see crude going up, we see a scenario where China devalues its currency massively. Okay, because China is, if you ask me, this is the perfect time for China to unwind its slowdown since COVID. Because US is on a weak wicket, China can take a complete opportunity at this point of time and can bounce back. But they're not doing this because China doesn't have annual elections. So they are okay. If economy suffers for some point of time, it doesn't matter to them. But if they rethink and they think radically different, and they come up with a big devaluation, they come up with a big fiscal impetus, and China economy grows massively, that point of time you will see FI outflows from India, because India people believe that today India is still a very, very good destination to invest. Though it is 6.5, rest of the world is growing at 2 or below. You pick up Europe, you pick up Japan, you pick up China, you pick up US. Where is there you get good growth? And with a stable political mandate, with no vulnerabilities on currency. And let me tell you one more thing. In the last 5 years, despite burning reserves last year, we are one of the central bankers who have accumulated reserves. So when I look at all stability, I think RBI comes out, or India still comes out to be a good destination. If China thinks radically and we get a geopolitical risk or a big significant China devaluation of their currency, we can start seeing outflows, and that is where yields will go up. Third, if growth doesn't start seeing heating up, and we see actual growth to be good, and RBI withdraws this ample liquidity, then this yields will start going up. So I would say three reasons. I will assign very, very low probability to all of them. As I told you, my base case is 80% that markets will remain in a range. You will see the short end to behave well, and RBI will continue to support. But there is a possibility that in the short term, if any of these risks comes, which is Bloomberg or US collapse for bonds to rally, or China or geopolitical for bonds to sell off.
Understood. So we have a few questions. Let me just start by the first one. So how are you thinking about relative value between sovereign SDLs and AAA papers, especially with state issuances expected to stay elevated?
So first of all, Abhishek, thanks for raising this question. I think it's a very, very valid question. In Q1, we don't see SDL spreads to be so elevated. And I would say that investors, the real money investors, should just lap in SDLs at this point of time at 705. I think a 10-year GSEC at 630. I am a big seller at those levels. If I was a real money investor, I'm not talking from a mutual fund perspective. But if I am a pension fund or a provident fund or an insurance company, I would just buy SDLs and 10-year corporate bonds, because all of them are available at 7. I don't see India inflation for the next 12 months above 4. With that context, RBI not hiking 7% is a clear no-brainer. Why we are getting those elevated levels? That is a good question. My understanding is, if you look at last 5 years, and that is why we had actually given the view also to answer Pinky's question, that long bonds will probably not rally much. The demand for real money investors have started to taper off. In the last 5 years, insurance provident fund and pension funds are called the real money investors. Their real money investor AUM massively grew by some, I think they doubled from 58 lakh crores to 110 lakh crores. So such massive growth in AUM. I think this year the flows have been tapering off since last, in fact, December onwards. And that is why the supply being the same on the long bonds, SDLs, corporate bonds, demand slowly slowing down. And last year we also had, let's remember, last year we also had JP Morgan flows to support. This year, that not being there, the demand supply dynamics started getting skewed. And that is why the spreads are available. So we believe that despite strong macros in India, the demand supply dynamics for long bonds is not so great, and hence these elevated levels are available. But if you're a real money investor, just go and lap it and buy and hold. If you are a mutual fund investor or a investor who's looking for the next 12 months to make capital gains from this, I believe there are significantly less chances. Because as I told you, fiscal consolidation is not going to happen. We believe that spreads will remain here. 10 basis compression can happen, yes, but I don't see big money to be made at these levels. So for a real money investor, very good to buy. For a mutual fund investor, I would probably say that we are at the end of the rate cut cycle. At the end of the rate cut cycle, people don't buy long bonds.
Maybe just a question to, adding on to the earlier question, is the credit spread pickup now adequate compensation for a credit risk strategy?
See, I believe so that in India, and that is why we at this point of time are still not advising credit funds, because credit funds are still having a very significantly higher expense. So has the credit spreads widened? Yes, because AAAs have rallied, people just wanted liquid assets, uncertain environment. So AAs have slightly underperformed. Is the credit cycle weak? No, we are at the best. So keeping aside the microfinance noise and couple of microfinance institutions which have probably gone bust, I would say the cycle in India is still very positive. Corporate India is strong. Health of the economy is very strong. Bank NPAs are at decadal low. NPAs are at the lowest since 2019. So except for microfinance and the noise around microfinance, I don't see any kind of concerns on the health of the economy or the credit sector. Credit spreads have widened. Are they good enough to compensate? I still don't believe so, because what I see is the large part of the benefit goes to the AMC, because AMCs charge very high expenses on credit funds. I'll give a classic example. A corporate bond fund charges 35 basis and a credit fund charges 90 basis on the direct plan. Now, the yield gap is less than 80 basis between a corporate bond fund and a credit fund. If 50 out of that is going to AMC, it doesn't help the end investor. So, as per us, I think, is the credit cycle positive? Answer is yes. Is the credit spreads, can it widen a bit? It can widen a bit, but I don't see massive deterioration. But I will still say that for the near term, let play through the corporate bond funds. Let's play the liquidity cycle first. And then probably when the spreads are too good, start looking at accrual as a strategy and target low expense credit funds.
I think we've ran out of questions. Yeah, maybe just saw one question from another investor. So, do you see Nifty falling to 21K? I mean, again, this is an equity related question. I'm not sure whether you will be the right person to ask.
So, Amit, see, I'll tell you my view. I'm not an equity specialist, but what I see is that RBI has been very accommodative. So, there are three levers for growth. And when you look at any growth asset, equity is a growth asset. And when do you see growth or risk on asset to work well is where there is some element of growth in the economy. Today there are, and then what can be the drivers for growth? Okay, what can be drivers for growth is one, RBI policy, which is your central banker. Second, fiscal. Third, external situation. I don't see external situation to be comfortable because you have one man tweeting every second day differently. So uncertainty leads to delay in investments and delay in capex, consumption, everything. Like today, if you are an investor, if you are a consumer, you will say, okay, let me wait. I think probably markets might get cheaper. Or vice versa. I'll delay because I've spent and consumed so much for the last 3, 4 years. Let's look at some environment, what market environment is happening. Similar is the behavior for a corporate. So if capex doesn't happen, growth doesn't come back. Government in India is consolidating because they are of the agenda that let's gun for a rating upgrade. I don't have revenue. Fiscal consolidation is the best way to go about it on a medium term perspective. They are not wrong. That is the how you should do as a as a policymaker. With that context, is only RBI is firing the guns. Now RBI has done largely everything. So I would say growth assets will probably remain range bound. I don't see a big driver for growth assets to give you 20, 30% return, nor do I see any environment today where it can collapse. So I would neither give one for 21, neither I'll go for a 30. This is my personal view. I'm not an equity expert, but I will neither go for both. I will say probably markets will trade in a range in this year. That is why you can still look at debt for one more year.
Devang, any one non-consensus or asymmetrical opportunity that you're closely watching in the market?
Okay, we are not commodity experts, but I think we like silver as an option. Gold has given phenomenal returns. Silver, there is good industrial demand. That is something which investors should look at as an allocation. I would still say that, then secondly, I will sum it up with that context that uncertainty still prevails. Last few years, we have made phenomenal returns thanks to market dynamics. I'm sure your advice to your investors has also helped them a lot to make the right set of decisions and returns. This is a year for protecting those returns, and hence have a asset allocation, probably have some bit of it in debt, and as a debt solution, just look at this income plus R. It's a tax efficient solution to probably solve all your problems, but with a 2 year investment horizon. So I'll sum it up with that perspective.
So, Devang, what happens to all the other categories of debt?
So my understanding is that, see, Asma, if I look at, there's 22 lakh crore of debt AUM in India. So I'll again give you a context. On March 2023, like I've been told that अभी तुम लोग क्या करोगे? AUM तो आएगा नहीं because efficiency is gone. We were at 14 lakh crores. Today you are at 22 lakh crores. So has the AUM gone up? 14 and a half lakh crores. Let's take 15 lakhs for so 15 lakh to 22 lakhs. Has the AUM gone up? Yes. There is a lot of institutional money which continues to grow in India, and that money is closer to now 10 to 12 lakh crores of AUM in debt. So that AUM will continue as per us. The retail AUM will be coming through income arb as a solution, but it will get invested in all of these categories because that is a fund of fund category. So that money will come back into our debt funds only. So that is why I think it will be just dynamically run, but as a solution, because in India, as I'll repeat myself, I think investors want tax optimal solution. That is why we are advising. It is not that the category, underlying category, Rajkumar, is corporate debt, or the underlying category 6 months back was gilt fund. So view will continue to remain on the basis of macro dynamics, and the underlying funds will garner money. Institution piece will continue to grow. The retail piece, as per us, will come through this income plus arbitrage as a solution, but will flow into these respective categories. So debt should continue to grow at a reasonable pace. I would say deposit levels in India. So it's around 8 to 10%. That is what we believe debt AUM in India will continue to grow on the mutual fund side.
And within this income arbitrage category, what's your strategy on the debt part of the fund of fund strategy?
It's dynamically run, and we follow a multi-manager fund of fund category. So that's a differentiation which we follow at Axis. Why so? I believe so that we don't want to get married to our views. So we always believe that select the right investment strategy and then allocate to the best in the industry, including us, so that we are not marred at any point of time by a fund manager bias or his investment style. So by following a multi-manager, you generally diversify the investor risk and try to get the best of all. So that is how we are differentiating. I think most of the peers are looking at single fund house, single fund strategy, whereby they're just looking at a particular category of funds to invest into as a feeder fund. We believe it should be dynamic depending on macro environment. So this is a one-stop solution. That is why I'm selling for investors. If we get bullish on rates, we'll increase. And if you can look at the fact sheet 3 months back, it was 100% GSEC, the debt allocation. Today it is 100% corporate bonds. And once the view is over, probably we'll move to the other category and the strategy which is based on the macro environment. But we follow multi-manager to remove all the biases, including mine.
I don't see any further questions on the chat box. Maybe on that note, Devang, thank you so much for joining us today. It's been an amazing discussion, and I hope our guests today also found this equally engaging and equally exciting. So thank you so much for taking time out today. And on behalf of PL Wealth, I thank all our guests who've joined us, and Devang especially for taking time.
Thank you. It's a pleasure, Rajkumar. Take care. Thank
Thank
you.
you. Thank you, everyone.